I think that this cycle ends with the next U.S. presidential election because the rhetoric is going to change. Whether or not the Republicans or Democrats win doesn't matter. I think that there's going to be a big push about affordability, about inflation, about we need to stop doing this money printing because it's harming the average person in the United States and around the world, and that's going to cause investors to question whether the authorities are really going to continue to just keep printing money, and that's going to cause a market correction. I don't think that we are out of this money printing phase yet. And so, yes, we've had this sort of pullback in Bitcoin because of a lull in money printing in the United States due to some technical factors, government shutdown, change of the guard at the Fed, those kind of things. But I think in 2026, we resume standard operating procedure, which is print money, and Bitcoin, crypto, stocks, real estate, everything keeps going up.
The drop caught a lot of people off guard, but here's the thing. This is exactly how crypto behaves in a bull market. Arthur Hayes keeps reminding everyone that a 15 to 35% correction isn't some warning siren. It's part of the rhythm. A move from around 125K down toward 80K looks dramatic on a chart, but in Bitcoin terms it's familiar. If you've lived through a few cycles, you stop treating these pullbacks like the end of the world. Hayes also pushes back on the idea that Bitcoin's famous 4-year cycle is driven purely by halvings. In his view, the timing always lined up a little too perfectly with global credit conditions. When the Federal Reserve or the People's Bank of China flood the system with liquidity, markets surge. When they tighten, everything breathes out. Bitcoin just happens to move faster than the rest. That's why this current run has such a specific character. It wasn't sparked by some crypto-native event. It was fueled by the unwinding of the reverse repo facility, a $2.5 trillion reservoir of liquidity. Once Janet Yellen started draining it in late 2023, that cash didn't disappear, it went looking for returns. Crypto, equities, real estate, gold, everything lifted together. Now we're shifting into the next phase, and the picture is getting clearer. With a big political stretch ahead and the 2026 midterms on the horizon, the incentive to pump money into the system is huge. Governments everywhere are promising spending, construction, defense, subsidies, anything that wins votes. What they're not promising is broad tax hikes. That gap between spending and revenue always gets filled the same way: more liquidity. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I don't believe so. I think that we've just had a little bit of a pause. And for those of you who haven't traded crypto, I mean, I've been doing this for almost 15 years. What Bitcoin dropped, what, 15%, 20%? That's not
35.
really 35. Okay, cool, whatever. That's kind of like par for the course for a bear market from, from 125 to, was it 80,000 or whatever we dropped recently. That's just normal market behavior. I'm not particularly surprised that we had that sort of pullback. So I wrote an essay about the 4-year cycle, and I did a chart study, and I mean, every major crypto commentator has their own opinion on this. My opinion is that the 4-year cycle lined up with a 4-year credit cycle between the Fed in the United States and the People's Bank of China and China. And that sort of gave us this impression that there's this programmatic 4-year cycle when in reality it was just a credit cycle. And so we went from the money printing of the US and China after the global financial crisis in 2008, 2009, which led to 2013. Then we went into a second massive Chinese stimulus post GFC in 2015 when they reflated their housing market again. Then we went into the COVID era stimulus in 2021, led by the United States. The current bull market has basically been powered by the reverse repo program, which basically is this program that had about $2.5 trillion in it. And Bad Girl Yellen, the former U.S. Treasury Secretary, engineered a way to reduce that down to zero over for about 18 months, from about September 2023 until 2025. And that was basically the catalyst that launched every single risk asset, whether that's crypto, gold, stocks, housing, whatever you want to call it, from then until now. And now we're basically in this transition period where, Team Trump and his Republican Party are going to print a ton of money to try to win an election in 2026. And the rest of the world is also printing money as well, maybe not to the same extent in the United States. So again, I just read the newspaper. And the newspaper, the politicians tell me that they're going to fight people, they're going to drop bombs, they're going to build things. Very rarely do I hear about raising taxes on a general level, other than, yeah, we're going to tax the rich people, whatever that means in your political context. But everyone else is going to get all these great goodies and they're not going to pay for it. And that's literally the message from every single politician all around the world. So it's show up at the polls and vote for me, or if you're not in a democratic society, please don't get angry. Support me as your strong person as a leader. So I mean, I don't think the top is going to be 2026. I think, we'll be markedly higher than we are today. If you maybe put a number, let's call it 500,000 by the end of
It's
2026.
outrageous. Where's that come from, Arthur?
That. But I think the market goes higher. I think that this cycle ends with the next US presidential election because the rhetoric is going to change. Whether or not the Republicans or Democrats win doesn't matter. I think that there's going to be a big push about affordability, about inflation, about we need to stop doing this money printing because it's harming the average person in the United States and around the world, and that's going to cause investors to question whether the authorities are really going to continue to just keep printing money, and that's going to cause a market correction.
Here's the way Arthur Hayes frames it. When big financial institutions finally step into Web3 for real, they won't build on the private blockchain experiments they tried years ago. After watching banks push projects like R3 and Corda, then quietly shelve them, the lesson is pretty clear. Without a public network validating transactions and securing the system, you don't get the point of blockchain. You end up with a slow database pretending to be innovative. That shift in thinking picked up speed once stablecoins proved how powerful open networks can be. Suddenly banks saw real settlement happening on-chain, at scale, without asking anyone for permission. And once you understand that, it's hard to go back to closed systems. Hayes thinks this is exactly why institutions will anchor themselves to Ethereum. Not because it's trendy, but because it already has the liquidity, the developer base, and the level of decentralization needed for serious financial applications. Tom from BitMine has been pushing the same idea. When the next wave of institutional adoption hits, it won't be random. It will funnel into Ethereum. Some players will build privacy-focused layer 2s or controlled DeFi environments, but their security still rolls up to Ethereum L1. That's the foundation traditional finance is most likely to rely on. Let's get back to the interview.
I think that Ethereum is a choice of traditional institutional investors if they want to do Web3. I've been doing this a long time. There's always been talk about, distributed ledger technology, or we love blockchain, not Bitcoin, all these sorts of things. It took all these organizations, like, your large banks, a very long time to understand that all these bullshit projects that were sold to them by a bunch of ex-TradFi people trying to do crypto, like R3 and Corda and these sorts of things, is nonsense. You can't have a private blockchain. You must have a public blockchain for security and to actually have real usage. I think the message has finally started to get through, especially with the stablecoin narrative. And so you're going to see large banks start doing crypto and Web3 using a public blockchain. I think the public blockchain will be Ethereum. And that's what is going to power this sort of next move higher in Ethereum. This is something that Tom Lee talks a lot about, the CEO of BitMine. I really subscribe to that thesis. And that's what I think is going to drive the Ethereum, resurgence of the price. Sure. I mean, there are people already using it now. They might build an L2 that has some sort of privacy features, or there'll be some sort of like whitelisted, CD file, that nonsense that people talk about. But it's then the substrate, the security layer is still Ethereum. The Ethereum community might have to revise how fees are distributed between secrets of fees at the L2 level and then what is paid at the security level at the L1 level at Ethereum. That's a debate worth having within the community. But at the end of the day, whether it's an L2 that's based on Ethereum, like Arbitrum, Optimism, these sorts of things, or it's the L1 Ethereum, this whole ecosystem is going to be used by TradFi to achieve whatever they want to do within Web3. So obviously Solana has done very well. I think the Solana move from 7 to 300 was driven by meme coins. The meme coin activity was on Solana. Obviously, meme coins have sort of died in terms of activity relative to what it was in sort of like 2023 and 2024. Solana needs a new trick. I don't know what that new trick is, but again, it's the number two largest L1. I think they'll find something. Will it be enough to power price performance greater than Ethereum? I don't think so, but I think pretty much every other L1 besides Ethereum or Solana is a zero, and they're not going to do very well. You know, the newest one is Monad, right? I think I've been on Twitter trying to tell people that I bought some. I did buy some. I think it's going to be another bear chain. It's going to go down 99% because it's another high FTV, low flow piece of shit VC L1. However, every coin gets their first pump. And people want to believe in the new L1 because everybody wants to invest in the new Ethereum like they would have in 2014 when everyone missed it, me included. But again, that doesn't mean that it's going to actually have any real use case. Sure, it depends on performance. If the stablecoin narrative doesn't play out, if there's not this sort of TradFi narrative, if people don't want to trade on chain, but they do want to have non-state money that's self-sovereign and privacy and all these sorts of things, Bitcoin wins. I mean, Bitcoin has been performing pretty well if you look at Bitcoin dominance, right? It sort of bottomed at, I don't know what it was, a lot lower than it is now and sort of tracked higher. It's what, like 60% right now. So Bitcoin is doing well versus majority of the alt space, apart from some standout winners. So I think that situation has already played out this cycle, which is why people said, "Oh no, there's no alt season," because the piece of shit number 2000 on the market cap list coin that I bought didn't go up 100x just because we're in the bull market. I think the number one thing is liquidity at the end of the day. That's all that matters from my perspective. If you get that right, then obviously you can come down into the, okay, well, other than Bitcoin, what other altcoins or shitcoins should I be trading? And that gets into sort of style and what narratives are popular in 2026. I happen to think that the privacy narrative will be a big one in 2026, and this is sort of foreshadowed by the rise of Zcash over the last 2 months. It's gone up, I don't know what, 10x or 10 to 20x, depending on when you got in, from 30 to like $600. Now it's around $500 a coin. But I think this is going to be the new narrative: zero knowledge proofs, privacy, quantum resistance. Whether or not these things are actual risks to the ecosystem is not the point. People are scared and they're going to invest in things that they believe are going to ameliorate these risks.
Momentum across crypto and traditional markets is starting to rhyme in ways you can't ignore. The swings look wild on the surface, but once you zoom out, the pattern is unmistakable, liquidity steers everything, and Bitcoin is simply the first responder. Corrections that shock newcomers barely register for veterans because they've seen how fast capital rotates when policy shifts flood the system. At the same time, the slow march of institutions toward open networks marks a deeper transition. After years of experimenting with closed-loop blockchains that never delivered real value, the big players are finally acknowledging where the real infrastructure lives. Public rails, broad liquidity, and credible decentralization are becoming non-negotiable, and that naturally pulls them toward Ethereum's ecosystem. Put these threads together and you get a financial landscape that's being reshaped from both ends: macro forces pushing capital into risk assets, and structural forces pulling institutions onto trustless settlement layers. The next leg of the cycle won't be defined by hype, but by how quickly these two currents merge. As these pressures converge, are we approaching a moment when digital assets stop behaving like an alternative corner of finance and start operating as a primary channel for global capital flows? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.